So, you want to invest but you're worried about losing all your money in the stock market. You see headlines about crashes, meme stocks going to zero and people getting wiped out overnight. It's completely understandable to feel that way. But what if I told you there's a book, written over 75 years ago, that holds the secrets to not just surviving the market, but actually thriving in it? This isn't some get-rich-quick scheme or a guide to timing the next big thing. This book is The Intelligent Investor, and it's famously called the best book on investing ever written by none other than Warren Buffett himself. His name is Benjamin Graham, and he wasn't just some author, he was a legendary investor and a professor at Columbia Business School. He lived through the Roaring Twenties, the devastating crash of 1929, and the Great Depression. He saw people lose everything, and it profoundly shaped his approach to money. Graham's experience led him to create a systematic, logical framework for investing that was completely revolutionary at the time. Before him, Wall Street was largely a place of speculation. He developed the concept of security analysis, which is just a fancy way of saying you should do your homework. At its core, value investing is the discipline of buying stocks for less than their intrinsic value. Imagine you're at a garage sale, and you see a brand new lawnmower that you know sells for $500 at the store. The seller is moving and just wants to get rid of it, so they've put a price tag of $250 on it. You know it's worth $500, but you can buy it today for half that price. That's value investing. Now, apply that same logic to the stock market. A stock isn't just a ticker symbol, it's a small piece of a real business. Graham's big idea was that you can analyze all of that information to calculate a company's intrinsic value. Sometimes the stock market, in its pessimism or panic, will offer you the chance to buy a piece of that business for way less than its calculated intrinsic value. To make value investing practical, Graham introduces two of the most powerful concepts in the entire book: Mr. Market and the margin of safety. Graham asks you to imagine that you are business partners with a very moody guy named Mr. Market. Every single day, he comes to your office and offers to either buy your shares in the business or sell you his shares. The catch is that Mr. Market is a manic depressive. Some days he's euphoric and optimistic, offering you ridiculously high prices for your shares. Other days he's deeply pessimistic and terrified, offering to sell you his shares for pennies on the dollar. This brings us to the second concept, the margin of safety. This is probably the most important single phrase in the entire book. Let's go back to our lawnmower example. The intrinsic value is $500, but the market price is $250. Your margin of safety is $250, or 50%. Graham insisted that you should never invest without a significant margin of safety. This is your buffer against bad luck, errors in judgment, or unexpected negative events. Let's use a real-world example that everyone can understand: buying a house. Imagine two identical houses in the same neighborhood. One is listed for sale at $500,000, which is the average price for the area. The second house, however, is being sold by someone who needs to move for a new job in 2 weeks. As an intelligent buyer, you'd recognize that the second house offers a $100,000 margin of safety. You're buying the same asset for 20% less than its clear market value. This principle extends beyond just finding temporary problems. Think about a company like Nintendo. For years, investors viewed it primarily as a hardware company, subject to the boom and bust cycle of video game consoles. But a deeper look would reveal its incredible portfolio of intellectual property, characters like Mario, Zelda, and Pokémon. This IP is a massive, undervalued asset. When the market finally recognized the power of this IP with the success of mobile games like Pokémon Go and the Nintendo Switch, the stock price soared. You can't talk about The Intelligent Investor without talking about Warren Buffett. Buffett first read the book when he was just 19 years old, and he has said that it was one of the luckiest moments of his life. Before reading it, Buffett was interested in complex charting techniques and market timing strategies, but Graham's words hit him like a lightning bolt. The book resonated so deeply with Buffett that he went to Columbia Business School specifically to learn directly from Benjamin Graham. He was the only student to ever get an A+ in Graham's class. He internalized the concepts of Mr. Market and the margin of safety so completely that they became the foundation upon which he built his entire empire, Berkshire Hathaway. Buffett famously summarized Graham's most important teachings into 2 simple rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Even today, as one of the richest people on the planet, Buffett still recommends The Intelligent Investor to anyone who asks for advice. One of the most valuable parts of The Intelligent Investor is Graham's clear warning about the common mistakes that trip up most people. The number one sin in Graham's eyes is speculation disguised as investment. Another huge mistake Graham warns about is timing the market. So many people think they can predict when the market will hit a bottom or a top. More often than not, people sell near the bottom and buy back in near the top after most of the gains have already happened. The Intelligent Investor is a skeptic and a realist. They dig into the financial statements, read the annual reports, and understand the company's competitive position before risking their hard-earned money. The market is a voting machine in the short run, driven by popularity and emotion, but it's a weighing machine in the long run, driven by the actual substance and earnings of businesses. Patience is not just a virtue in value investing, it is a requirement. So, what can you do, starting today, to become an intelligent investor? First, start with what you know. Don't invest in a complex biotech company if you don't understand what it does. Instead, look at businesses you interact with every day. Second, start saving and invest automatically. Set up an automatic transfer from your checking account to a low-cost index fund every single payday. Third, make a commitment to lifelong learning. Dedicate just 15 minutes a day to financial reading, and the compounding effect on your knowledge will be incredible. Finally, and most importantly, adopt the mindset. Start thinking of yourself not as a stock picker, but as a business owner. When you look at a stock, don't just see the price, see the company behind it. By focusing on business value, practicing patience, and controlling your emotions, you are embracing the timeless wisdom of Benjamin Graham and setting yourself on a path to true, sustainable financial success. The incredible thing about The Intelligent Investor is that its core principles don't get old. It's simpler than you think, and it all starts right here.